So hi, everyone. Please go ahead.
Hi, good afternoon. My name is Luca Blasi. I manage a team of risk specialists at the Supervisory Risk Specialist Directorate at the PRA.
Hello, I'm Marina Antoniou. I'm the head of Global Markets, Risk and Control Assessment at BNP Paribas. I specialize in capital market risk and controls with a focus on contact risk, rock trading, and financial crime.
Good afternoon. I'm Jeff Simmons, and I'm the CRO and the COO of MUFG's Brexit entity in Amsterdam.
Thank you. So we have a number of questions here. We'll be talking for approximately 20 minutes, and then we'll leave about 10 minutes for you to ask additional questions. If you do have some follow-ups while we're discussing, you may just want to raise and jump in. We're pretty laid back. So the first question, Jeff wanted to respond to. How have FIs adapted to recent macro and geopolitical risks?
I think wanting to respond to it is not quite accurate, Erik, but I think I guess I'm going to throw out a question there rather than answer the question if I can, so I'll keep it brief. Is what I'm interested in the conference and in our discussion is how we're going to react to this paradigm change that we're seeing from even 2 years ago to now. We've gone from a low interest rate, a low inflation, a peacetime Europe, to almost exactly the opposite, right? And how are our models coping? How are our people coping? And what can technology do now in order to bring us into this, as I said, this new paradigm? And so I'm not really sure what the answer is to that, but we need to come up with an answer quick, because the horror that we've gone through in this last year with all of this happening, we need to realize it's the new normal, and we need to adapt quickly.
Thank you. Luca, the next point. What is the regulatory approach to risk management in the new risk environment?
Yeah, it's a good question. My answer will be is the same approach we used before. In the UK, we have a document that describes the way the PRA supervise banks and insurance. I found our approach very pragmatic, quite flexible. The way we do is documented. You can find on our website, but it's to identify the gross risk that can impact every firm we supervise and can put in danger our three objectives we have. One is to have an institution safe and sound, one to ensure competition between banks, and the third objective was introduced more recently is to make our system very competitive. So to answer to your point, our approach basically doesn't change as such. Obviously, we want to ensure that the banks, the institution we supervise, across the three lines of defense, have a reasonable and robust approach to identify, measure, and manage risks. So in this sense, we are less prescriptive compared to other regimes, but that allows us to flex to the various situations. And definitely, we acknowledge the challenge that firms have, and obviously, this new environment have to for firms to survive in this new environment, they need to have a high level of agility and flexibility in order to adapt.
Sorry, can I ask a question? Am I allowed to ask a question? And so do you think the regulators got that level of agility? I mean, we can react. Do you think the regulator can? Sorry to put you on the spot like that.
No, that's good. Obviously, I can always not answer the question, but I will answer this one. No, I think, in a way, yes. I tend to do lots of work globally with colleagues at New York Fed, the SSM, and FEMA in particular. And obviously, our regulatory regime, by definition, the policy side has to be slow, because we normally can have new policy only when risk are crystallized, we want to tackle it. The actual supervision of firm can and normally is agile in the sense that we enter in a dialogue. I personally, in my team, we look at across the risk, including trading control. That is the new emerging non-financial risk. And my mantra is obviously we need to explain ourselves. We need to share with firms what our concerns are, but also we need to make sure that the firms see the risk we see in the firm, and there is a dialogue on how to solve this. But so I don't know if I answer you, but obviously I can answer only for what I do.
No, sorry, I think that's a great answer. Thanks. Sorry, Erik.
Thank you. The next one to Marina. How are the latest technological innovations impacting risk management? And we're looking for an industry perspective on this.
Yes. Well, that's a big topic. In terms of the industry, what we see is mainly two categories. The first one is digital transformation of existing processes, existing infrastructure. And the second is artificial intelligence. To start with the first one, digital transformation, there's broad adoption of new automated tools in order to improve efficiency, improve sustainability, save time, and also reduce human error. Now, just some examples. We're seeing automation, mass automation of routine tasks, or automated data feeds, populated traders' supervisory dashboards, or automated data feeds that calculate contact risk KPIs automatically, or creating, automating supervisory governance reporting. So this is mainly on the digital transformation. Now, when it comes to AI, to artificial intelligence, AI is constantly evolving, and it spans across risk categories. For example, in contact risk, for contact risk, AI can be used, for example, in market abuse, for surveillance, in order to detect scenarios of collusion or price manipulation. Or AI can be used in fraud, so in order to auto-generate fraud alerts. Or artificial intelligence can be deployed in other areas such as financial crime in order to auto-generate anti-money laundering alerts. And across the board in risk management, we see that AI can be used to identify emerging trends that can be used in the risk taxonomies. Now, it all sounds very exciting, but there are limitations, there are challenges that need to be considered. For example, the data, the data that is used in the AI models. We need to consider the quality of the data, the completeness of the data, any embedded biases into the data. Also, the AI algorithms, we need to consider how robust are these AI algos. So we need to ensure that there is a strong governance process of how AI is developed. Also, another example, another limitation is the risks that come with AI. We have cybersecurity risks that can result in data theft, in data manipulation. We have data privacy risks. So we see across the market that AI is evolving, but there's action that needs to be taken to address these limitations. The other consideration is resourcing. And it's not just with AI, with any innovation. Do we have the right resourcing? So risk management functions across the board, they need to think about upskilling existing staff, or expanding the teams to include AI specialists or data scientists. And at this point, I have a question myself around artificial intelligence and regulation. So, Luca, in terms of regulation, would regulators be comfortable with lots of reliance being placed on artificial intelligence? And secondly, with all this evolution on AI, how can regulation keep up, with all these emerging AI applications, constantly changing applications?
Thanks, Marina. I was expecting a question on AI. It's a very sexy topic, obviously. So I will answer citing a document was issued last autumn. It was a joint paper of the PRA and the FCA on artificial intelligence and machine learning. As I was mentioning before, a new objective for the PRA is to also ensure the competitiveness as the British system. And that paper is in line with this. In a way, the approach the UK is taking to this new technology is trying to create a framework that protects the system and the firms from the risk, but not inhibit innovation. Because obviously, we see the role of the regulator is to foster innovation rather than... Although AI, like any technology, got lots of potential benefits, there are also potential risks. And in the paper I was mentioning, you can find also on our website, there are 3 drivers of these risks. You mentioned all of them: data, the model itself, and the governance. So from my point of view and the work I do, we want to ensure that all these 3 elements are tackled properly by firms. My job is not to run banks, but to make sure that the banks are run in a safe way. So a key item in a firm, obviously, is the model validation process. That should be robust enough. And to your point, these are new type of model, so new skills. The traditional team might not have the right setup to also look at this model. A key question in the industry is the explainability of the model itself, that at the moment is... I can see from my point of view is also one of the main items that slow senior management in banks on the adoption of these tools, because also the senior managers themselves want to ensure that the model acts as to do. And the third one is the governance, that is very important in terms of level of seniority and transparency at all the level of the bank about these tools, and now their introduction in a firm can be managed from a risk perspective. So just to answer, we had that consultation paper and discussion paper was issued last year, and as of today, and this is purely a spurious correlation, it's not due to me or the conference, today we publish our new supervisory statement on model risk management, in which there will be a new guidance that banks have to take on board with various aspects of models, including the model validation. So, and that will apply also to AI machine learning.
Can I ask you a question, Marina? So you mentioned upskilling, and I'm going to come back to my paradigm shift. Do you think the AI models themselves need some form of upskilling, given that they've only been around in this previous rather benign environment? Now we've moved to a new one. Do you think we need to teach the AI models more?
Yes, that's a very good point, in fact, because there's lots of focus on the AI, on the outcome of the AI, whereas there should have been a focus on what you put in the AI models and how they work. So one element is what type of data do you use? Is it historic data? Over which periods? And how relevant that data is given the present situation? Yeah, so that's one, the type of data, historic data. Then the other aspect, if there are any biases within the data, any hidden biases, so how do you identify them? How do you clean them? And the third point is who interprets the outcome of the AI models? Yeah, do you have people who are familiar with the outcome, who can understand it and draw the right inferences?
Yeah, no, I agree. I mean, I know there's been a lot of work on climate risk, for example, and okay, I've been in risk management since dinosaurs ruled the earth, but I can't remember there ever being a climate crisis in my time. So
Except there is right now.
yeah.
Just a quick pause. I know we're supposed to hold the questions until the last 10 minutes, but I feel a general flagging happening. Does anyone have a question they'd like to bring up now? Please.
I know it was only a few months ago, and there was a lot of interest rate rises, and a certain bank with the letters S and a V and a B might have been able to see, you know, that they should have hedged or done something internally. But where were the regulators?
The question to me. Yeah, it's a good question. Probably technology will have helped the firm as well. Obviously, I cannot comment on other regulatory framework. There is a point though on all the crisis, and for me is interesting learning point in terms of the innovation in technology in particular is creating new business models. Now, if you take the example you are indicating, I can see that as a good probably case of aggressive assumption on behavioral model of the retail side of the banks that normally are managed and modeled through traditional way of behavior of customers. Take into account the introduction of mobile technology and perhaps also the concentration of your portfolio on one part of highly net worth individual and firms should have triggered the management to have a maybe more robust scenario analysis. And so that obviously is my personal reflection on the crisis. But to Marina's point and Jeff, I think nowadays there are some emerging risks due to the change in technology that we haven't experienced in our lifetime. And perhaps they will crystallize in way that are not historically there. You know, I agree that with Insight there will be more focus on that, but I also noticed that the three banks that are problem they were in California. So, you know, that's another thing that for me, it makes me think, you know, is there probably a byproduct of growth on the technology business in there that create this. But just my personal observation on this is a good challenge, and I take on board. And in my work, we tend to have horizon scanning and look at risk, you know, that are not obvious, but is unfortunately it's not so easy.
And just add something to your point, I totally agree. So what we see is that innovation and all these technological advancements, they create new types of risk, yeah? So across the industry, this is a challenge because these risks, they need to be in the risk taxonomies in order to be managed. So in addition to getting familiar and adopting innovation, organizations may need to also develop new tools, yeah, or new processes in order to be able to tackle innovation or pull off the digital transformation.
I mean, I agree, but yeah, again, if I go back, you know, through my experience, then, you know, SVB was essentially a pretty standard crisis, right? And then how would it have been handled maybe 10 years ago was maybe the CRO or the CEO would have gone out of his office door, opened it up and said, you know, you and you, I need you in my office now. We've got a crisis here we need to sort out. But with the new paradigm of, in this case, home working, they were in completely different time zones. And so to get everyone together to sort out the crisis was even difficult. Sorry, I know we're not meant to be doing a post-mortem of SVB, but I think it's a good question. I think the technology just accelerated the problem.
Just to add very quickly, I mean, in the 1930s, you have this picture in America, you know, people queuing, actually 20 years ago, Northern Rock, right? So people queuing outside the branch. Now you don't queue virtually, you know, just click a button and you have a queue on the tech stack of the firm. But yeah, so this is another fact. But I think there is a question about technology, and there is a question about also big banks and traditional banks that are big container And, they have been growing through acquisition, sometimes some through external, growth. And most of them have challenges to integrate system. And so, in an ideal world, different firms have different challenges. And these new tech challengers banks, they start from scratch. So they have the advantage of having infrastructure, but perhaps has to be also beef up with some experience on, stress testing and scenario. So the two worlds have to get together. So I stop here.
Quick question, and it goes out to the panel generally. Do you see in your specific industry and in your space financial risk and non-financial risk managed differently? I know traditionally there has been a different approach, and it's very well characterized in financial crime, for example, where it's been one silver bullet after another that everyone's latched onto to try to resolve the problem instead of dealing with it. Do you see something similar happening in other spaces?
I'm going to say yes and no, just to avoid answering the question. Because I think, again, I keep on coming back to my paradigm. That's because I think we need to start thinking differently. Is on the pure financial side, I think we're placing more and more reliance on models, and are our models and our systems keeping up with the risks that we're identifying? I think on the non-financial risks, which ultimately translate into financial anyway, I think there's a whole lot emerging that perhaps we're not necessarily monitoring or in control of. I mean, HR risk, for example, people making lifestyle choices now, whereas before in our industry it was you just work 20 hours a day and that's your life. Now people don't want to do that. So are we losing people to the industry? Experience, technology to support them. I don't think the traditional risks have gone away. I just think there's a whole lot of new ones coming our way that we need to start identifying and somehow controlling.
Maybe jump in as well. As I was describing before, my team is responsible for various areas, but from a high level, we deal with market and counterparty risk, valuation, and trading control. That is the non-financial risk element of the control environment. So to answer your question, after Lehman, the answer of the regulators was bifold. Capital and liquidity are the two things that can take a firm down. So that was the paradigm, if you want, after the crisis. And I have to say, COVID taught us that actually, from a capital perspective, banks are in a different level. It would be quite difficult for a big bank to go bust. Although what hasn't catch up with that is the controls. The trading control to catch non-financial risk that eventually can materialize in big losses. Not so long ago, we have some unauthorized trading incidents that results in several $1 billion are coming from nowhere. So this is not capitalized as well. So this is an area where my team does work. And what we try to do is to ensure that firms have a robust control environment to catch these things before. But definitely is behind compared to the financial risk.
Yeah, and in terms of non-financial risk, it can result into huge losses. So it can translate to a huge financial loss. Let's think about contract risk. Yeah, we have the consent orders, and this is public information. They resulted in billions of dollars. So it doesn't mean that because it's non-financial risk, it cannot create a loss. It can create a huge loss. And the problem right now is, how do you control it? You can have your surveillance controls. You can have, let's say, voice, trade, e-com surveillance. But still, it's a very difficult area to control. And this is where technology comes in, and they're trying to come up with some innovative solutions to mitigate conduct risk.
I mean, one thing that I've noticed in the industry for a long time is that data in some areas of the financial institution are paramount importance, and data in other areas not so much. And unfortunately, when we talk about the shift in moving to technology, it requires a standard approach to data that institutions, very few institutions, seem to have grasped early on. Are you seeing that reflected now in the way that institutions are approaching elements, especially when they're managing risk? If you'd like to start.
Would I like to start? No.
Okay, then I'll start.
I think BCBS 239 and the regulators have tried to force this data discipline, right? And sorry, please not outside of this room, but I think that's a good thing that the regulators have done to force that discipline. But adherence to it, just because the regulator says, I think is the wrong approach. It should be because we want our risk management framework, be it financial, non-financial, or first line, second line, third line, whatever, to be robust. And so it should be something that should grow out of the organisation. And getting your data right is expensive and therefore difficult to justify big spends in the good times when it's not a problem.
Well, with data, it looks like it's going to be inevitable for institutions across the industry to ensure that they have robust data, because we have in the industry there is obviously lots of regulatory focus. They can come and examine any bank, so they need to see the data. You have also internal reviews, you have internal audit, you have external audit, so you need to have the right data in place. And in addition to that, with automation, if we're moving towards more automated tools, those to work and to give you meaningful results, they need the right data. Otherwise, how are you going to make decisions if the data that you put in the model is not the correct one, is not the complete one? So what we're seeing in the industry is more of a focus on data and actually benchmarking data between institutions, in order to, let's say, try to determine what's my benchmark, right? What's my benchmark in terms of controls, in terms of data to support the key controls.
So the standards, basically.
To answer to this question, I might use the big bad F word, that is FRTB. I know it's been quite down by the industry. I don't know if you're familiar with it, but it's the fundamental review of the trading book. So if you're a big bank with a trading book side, there's this new piece of regulation that we require an overhaul of the entire architecture. And one of the main obstacles was data. Before joining the regulator, I used to work in industry in Scandinavia, in Nordea, and I was actually business lead on a data integration project because the regulation was forcing us to do something that was important, was very expensive, but the senior management would not have done on his own accord. And the key challenge of FRTB from a data perspective is having a clean time series with a clean audit trail of all the changes that is aligned between risk and finance. That is one of the most complicated things you can do, and that requires going back 10 years and clean all the time series used in risk. It's a big effort, but to your point, Jeff, once it's done, I think we'll put the firm on a different level. So FRTB is going live. We are expecting the application by next year. There might be a different number of firms apply for internal model, because this rule apply only if you want to have an internal model. Although I can see that there has been a general progress on the industry on thinking how to implement this piece of regulation and what type of technology changes has to be done. But data is one of the essential part of that regulation.
Okay, thank you. We have one more kind of key point, and then we'll move on to some questions in the audience, and then wrap up with any other comments or points that the panelists would like to make. What factors influence the CRO's decision-making process when they're thinking about partnerships, data teams, data partnerships, or which industries that they should align to, et cetera? Just generally speaking, as we look forward, do you see elements that are key in that decision-making process?
Me again.
Just why don't we start with you, just to give him a break? Okay. Jeff's struggling.
Yeah, that's fine. That's fine. So, I mean, what we see in the industry, yeah, there are some organizations that decide, to set up their own fintechs, their own RegTechs, yeah, or there's some other organizations that decide to partner with a tech company, let's say with a fintech startup. Now, if you decide to partner with a third-party company, of course, there's some risks, like data sharing, confidentiality. So overall, you need to do your third-party risk assessment, and you need to take into account any specificities that relate to a tech company. Now, at the same time, there could be benefits. Yeah. So a tech company could be using cutting-edge technology that you may not have in-house. It could employ AI specialists and experienced data scientists, and also a tech company could have other clients in the industry, and it can bring you the industry perspective. Yeah.
Thank you. Would you like to go?
Very quickly, I think from our side, it's not an area I look at, but my colleagues look at operational resilience angle of banks, and exactly what Marina was saying. We have also a supervisory statement on third-party risk supplement. So our view is that it's up to firm how they want to implement the strategy, and often a partnership is the best way, the most economic way, but the risks stay with the firm. So the firm has to demonstrate they are on top of the risk and can mitigate both the third-party risk, but also the risk management of the function or process itself. So otherwise, yeah, it's definitely, I always say, I'm not in the business of managing banks, but yeah.
Thank you, Luca. Jeff?
Yeah, so I think, I agree, what you two said. I think the collaboration is important. Clearly the assessment of the vendor is paramount. But then also the future-proofing of what product you end up with, right? Whether it's an off-the-shelf or whatever. And because if you're not future-proofing it, you're just introducing operational risk further on down the road, which it just doesn't do any good for anyone.
Making sure it aligns to your data strategy,
yeah,
and
exactly.
your technology strategy as well.
Yeah.
Yep. Excellent, thank you. So thank you very much. We'll come back for the final one, how you want to see the future. But in the meantime, do we have any other comments or questions?
Thanks. In this era now, where fund managers tend to be more lazy as far as passive investment or indexing everything, and everybody trading ETFs rather than researching individual stocks in sectors, what happens when we, for example, have a 40-year-old, fully automated, tried and tested equity research source code that will say, for example, the market says the bank sector is out of favor. So everybody sells a bank ETF or a bank sector ETF because they haven't got the resources or they can't be bothered to research each bank stock. So our model, our source code will then say that nearly every bank in that sector is in play as a buy. And this has been going on, for 25 years when it's been rolled out to the market. So what do you do then as far as risk is concerned? Because obviously you've got a concentration risk issue when all the banks are in play, and the model's telling us that, and it's been telling us for years, up or down. So how do you cope with that? Do you just say that's an active management quant type model and it's in one section of the investment process, or do you clip its wings and not allow it to do or optimize, the power of the source code?
You would like to wade in? I would like to make a comment. I think you need to be careful or cautious about, especially after the discussions that we've had about the changing environment and the technology, to keeping a model static for an extended period of time. It's probably something that needs to be relooked at, and discussions need to be held in the organization. It's up to the organizations to decide their risk appetite, and the model should be part of that discussion.
Maybe I can also jump in. I mean, from a bank perspective, let's say we regulate banks. So a bank perspective will have some position on their book, and the theory says that all the risk related to that position should be hedged. Now, the strategy you are identified, they probably will be implemented for clients that will have a, share all the risk on the strategy itself. So if it's a strategy on liquid assets, like the case you say on ETF, it's relatively easy to hedge, I would say, especially on big markets. There are situations where there are idiosyncratic risk. A famous case has been the KOSPI, the Korean stock exchange, that was a favorite of equity autocallable strategies for Asian clients. And few banks go banned because, exactly to your point, in a smaller market, if you get a crowded strategy, it might create additional risk. Although on market like US, UK, it's very difficult that there will be such a issue with re-hedging the risk from a bank perspective. So one angle is the bank, the other angle is the wider public and the investment. And this is more a conduct issue, if you want. People should be invested. If they're a retail investor, should understand the risk, and the role of the entity that facilitates the investment is to explain and ensure they understood the risk. It's more my sister organization, FCA, deals with that angle. But I think that there is, for me, the main question is if the algo is wrong. In your case, the algo is tested, is okay. But if the algo is wrong, it's a new strategy, then I would like to see the banks having a proper validation, proper check and analysis.
Any other comments?
No, I would just agree with what you mentioned. Basically, if you're using a model, and I'm not a model specialist, if you're using a model, you want the model to be current, and to capture what's happening in the economy, what's happening in the market. So ideally, you will have model specialists who review the input, the parameter, the coding, backtest the model to make sure that it captures these elements.
I actually think it's a great question because I'm looking at it from the other side, in that is there a concentration in not so much a methodology or a model, but in the strategy or the approach. All right, so. Yeah. And okay, thank you, because I don't have an answer. So having this concentration, and then I'm sorry, I'm going to say it again, but it may all work fine when everything is working fine, but then when you have a paradigm change, then all of a sudden you end up with the need for a different model. You end up with a different model. How do you manage the concentration of, I'm going to say methodology, if I can call it that, across the market? I'm sorry, Luca, I'm going to have to look to you again, but because I'm not sure how you can do that, and I'm not even sure AI would pick it up, because AI would have the same, I'm going to say, methodology, philosophy, as your 25-year-old model. Okay, we can talk about model validation, etc., but it's going to have the same philosophy, I would fear. Yeah.
I can quickly say, when I started for my PhD, you assume that in the market there are lots of agents, and to your point, if people start to lose money, someone will take an opposite view. If, let's say, quantitative strategies are crowded, the expectation if people believe in the free market is that there will be someone that spot an opportunity there and take an opposite position, and eventually all these forces settle on the reality, financial markets are dynamic systems, and it's very difficult also to, regulate them in a way. There is a concern, I think, to be done in a split between retail investors and institutional investors. Eventually, institutional investors, they take the equity risk. They have to bear a risk to have a return. And retail investors has to be protected. They have to understand the risk. And this is a function of the asset management industry. The regulator ensure that they are not missold products. But otherwise, am I dodging the question? It's very difficult. But concentration is on our radar, and we try too much. In the UK, we also have a concentration adjustment on the equity for the valuation of certain trades. And we use that as a lever. If we found some crowded position in banks, we ask them to put additional capital for that.
So we're on the end of it. I want to thank our speakers. It was an excellent discussion. Thank you very much. And the audience for being so patient. Thank you.